Welcome to The Explainer. If you're looking at the new 2025 tax changes in Pakistan and your head is spinning, believe me, you are not alone. All that noise and give you a clear, simple guide to what's actually changed.
That feeling, right? That wave of stress that just washes over you when it's tax time. It's already complicated enough, and then they drop a whole bunch of new rules that make it feel, well, almost impossible. But don't you worry, we're here to help.
Here's our game plan. We'll start with the new rules for businesses. Then, we're going to dive into that big property tax puzzle. After that, we'll demystify the rules around foreign money, expose a really common trap for non-residents, and then wrap it all up with one.
First up, businesses.
The 2025 tax year is bringing in some pretty big shifts, especially if you're in a partnership. We're going to focus on the two biggest changes you absolutely
I want you to burn this number into your brain. 300 million Pakistani rupees. Why? Well, because this is the brand new sales number that, once you cross it, triggers a massive change in compliance for partnerships, or what the tax law calls associations of persons.
Here's how it works. If your partnership's turnover, your total sales, goes over that 300 million rupee mark, you are now required to get your accounts professionally audited. And you have to file those audited accounts right along with your tax return. And if you don't, the penalty is huge. The partners in the business completely lose their tax credit on that income. It's a simple change with a very, very expensive consequence.
Okay, the next big change for businesses is aimed squarely at builders and developers. You know, for years, it was a common strategy to just delay declaring profits by saying a project was still under development. Well, a new rule, Section 7F, has been brought in to put us.
It's actually pretty clever. Instead of waiting for a project to be marked as complete, the law now deems or assumes that a chunk of any advance payment you get is profit for that year. As you can see here, if you're in construction and sales, it's 10%. For development and sales, it's 15%. And if you're doing both, it's 12%. That profit now has to be declared in the same year.
All right, next section. Let's try to solve the property tax puzzle. I'm not gonna lie, this is one of the most confusing, most argued about areas of tax law right now. We're gonna break down the two rules that are causing all the headaches.
First, we have the Section 4C super tax, and boy does this thing have a messy history. It was brought in back in 2022 and, get this, it was applied backwards, retroactively. That, of course, kicked off a storm of legal challenges. The government tweaked the rates in 2023, but the legal battles kept going. So what's the key takeaway for you right now? Even though the original case is still sitting with the Supreme Court, this tax is absolutely in effect for the 2023, 2024, and 2025
And now for the
tax.
infamous Section 7E. To really get this, you have to understand a strange little concept called deemed income. Think of it like a legal fiction. The law basically looks at you and says, hey, we are going to assume you earned income from this property, even if not a single rupee of cash ever touched your hands. This idea is the engine that makes this entire tax run.
The official formula in the law is super confusing. Something like 5% of the property's value gets taxed to 20%. You know what? Just forget all that. Let's cut to the chase. What it really boils down to is this. It's a 1% tax on your property's fair market value. Plain and simple. That's the only number you need to remember. And this is where things get really wild. Section 7E has turned into an absolute legal battlefield. It only applies to residents who own property worth more than 25 million rupees. But the core of the fight is this one question. Is that 1% tax calculated on the property's current fair market value or on the original cost you paid for it? Different high courts across the country have given completely opposite answers. So for now, the whole thing is in a state of chaos while everyone waits for the Supreme Court.
Let's switch gears and talk about the big one, money coming into Pakistan from abroad. This is probably the area with the highest stakes, where a simple misunderstanding can lead to some really serious
Here's the next
trouble.
magic number you need to know. 5 million Pakistani rupees. So, the law basically says if you buy an asset, could be a car, a piece of land, doesn't matter, and you say the money came from a foreign remittance, the tax office won't ask any questions. But only up to this 5 million rupee limit.
And this is a super important point to understand. Remittance is not a type of income like your salary. It's an explanation. It's the answer you give when the tax office asks, hey, how did you afford? Exactly where so many people get tripped up. Let's say your dad, living abroad, sends you 20 million rupees. Your first instinct might be to just declare it as a remittance. That is a huge mistake because it's way over the 5 million limit and basically guarantees you're gonna get audited. The smarter and totally legal way to do it is to declare it as a gift or a loan from your family. These don't have that same limit, and they give you a clean, simple, and perfectly valid explanation for where that money came from in your wealth statement.
Okay, now moving on. Let's talk about what the source material for this explainer calls the single biggest, most common blunder that non-resident Pakistanis make when they're filing their taxes.
The source puts it so bluntly, I'm just going to read it to you. Filing a wealth statement for a non-resident is the root of most litigation. Think about that. Voluntarily filing a document that the law doesn't even require is the main reason non-residents end up in tax.
So why is this such a big deal? Well, it all comes down to a fundamental difference in the law. A resident of Pakistan is taxed on their worldwide income and their worldwide assets, but a non-resident? They are only taxed on their Pakistan-sourced income. That one little distinction changes absolutely everything.
And here's what that difference looks like when it's time to file. A resident has to file two things: a tax return on their global income and a full wealth statement that lists out their global assets. But a non-resident, they only have to file a tax return covering their income from Pakistan. And look closely, see what's missing? That's right. By law, they are simply not required to file a wealth statement.
Clean, simple, and correct process for a non-resident. First, bring your money into the country through proper banking channels, like an FCVA or NRV account. Second, when you buy property, the purchase tax you pay is the final tax. Third, when you sell it, the capital gains tax you pay is the final tax. That's it. You never have to get tangled up in declaring your assets in London or Dubai, because the law simply does not require it.
We've gone through business audits, the chaos of property tax, and those tricky foreign money traps. Now, let's pull it all together. Let's boil it all down into one single, simple golden rule that really governs everything we've talked about.
This is it. This is the heart of Pakistani tax law. It's not just about your income, it's about reconciliation. For every single asset you own, your house, your bank balance, your car, you have to be able to answer one simple question: where did the money for this come from? Your entire financial life needs to tell one single, consistent story that you can explain and back up.
And that brings us to our final question for you. As you get ready to file your taxes this year, don't just think about numbers on a form. Think about your entire financial story. Is that story clear? Is it documented? Is it ready? Because making sure the answer is yes today is the absolute best way to protect yourself from any trouble tomorrow. Thanks for joining us on The Explainer.